Hi, and welcome to your monthly market review. I'm your host, Nick Rower, joined today by Rusty Vanneman, Chief Investment Officer here at CLS Investments. Rusty, last month was great for the stock market. Can these gains continue?
I think so. I mean, there's two big reasons why we could have gains into year end. And the first is it's a seasonal factor. We're coming into November, which is one of the best months of the year. And then December is the best month of the year. So just from a seasonal standpoint, I mean, the market usually finishes pretty strong. The other thing, and we've written about this, we've talked about it, is something called the presidential cycle. So we follow the election cycle, and the stock market tends to have this sort of rhythm to it based off the election cycle. Well, long story short, after the midterm election, the stock market generally does pretty well. Okay. So those are two big reasons why we think the market could do pretty well. The odds favor more gains.
Okay, so great. So short-term outlook, positive.
Yeah.
Does that mean that one should take a little bit more risk in the market?
Great question. We are saying not so fast. And again, I'm sounding like the two-handed economist here. I guess I'm the two-handed PM, but there's two reasons not to be pedal to the metal here. And the first is the Federal Reserve just announced that they're going to discontinue quantitative easing. This is basically putting a lot of liquidity into the marketplace. Since 2009, whenever they've kind of pulled back on QE, the market has underperformed. So far the market's done all right, but you just got to see how it's going to shake out. The other thing is investor sentiment. We talk a lot about it here, and something that we've noticed when a lot of investors get really bullish, the market tends to underperform, and vice versa. When everybody gets really negative, the market generally does better. It's interesting, in Labor Day this year, investors were really, really bullish. That was right before we had this 10%, almost 10% correction. And then at the depths of the market pullback that we had recently, investors got really negative right before it took off again. Well, guess what? We're right back in a bullish extreme again. So again, that just has to put a little caution in the air.
Okay. Yeah, great. So then short term, we get it. Let's move to the long-term investor.
Yeah.
What's a reasonable expected return moving forward?
Yeah. Well, again, the short-term stuff, I mean, really anything can happen, but longer term, I think investors can have a little more conviction in what returns could look like. So let's kind of go back to the tape here and the history of the market. I mean, we have data going back to 1871, and the market has had an average annual return of just under 9% during that time frame. And half of that return has basically come from dividend yields, and half of that has come from earnings growth. So that basically makes, I mean, there's a little bit that comes from a change in valuations. So really the building blocks of returns, you've got dividend yield, you've got the growth of the yield, and then change in valuations. That last part's kind of this speculative component. Okay, so that's sort of the backdrop. So what have we done like the last 5 years? Well, dividend yields are lower than they have been. Earnings growth and inflation have basically been similar to long-term averages. And then the speculative component has been huge. We've actually seen a big valuation expansion. So where are we at right now? What can we expect maybe over the next 10 years? So let's go over these building blocks. Dividend yield. Long-term average over 4%. We're at 2% now. Earnings growth. The long-term average since 1871 is like 4%. It's actually a little better in recent time frames. You know what? We could expect a similar sort of number moving forward.
Okay.
So you got 2 plus 4, we're at 6%. Now we got the valuation change, and the market, if anything's a little expensive, if anything, maybe a little bit of a haircut. That's a long way of saying maybe expected returns instead of being 9%, probably going to be closer to 6%.
Okay.
Yeah.
Awesome. Well, thanks for the insight.
Great.
That'll do it for this month. As always, thank you for your time and trust in CLS Investments.